Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Hello, ladies and gentlemen. Charlie Jewett with the Renovating Retirement Podcast, bringing you episode 78. I'm the whistleblower in the financial services industry, exposing all the lies and crappy strategies that are taught to you because they line our pockets, and the strategies are just absolute garbage and trash. I'm taking on one of the biggest elephants, the sacred elephant of you should pay off your mortgage, which is a crappy, horrible strategy, terrible advice. Home equity, every single dollar that you stick inside of your home through a down payment, using a 15-year fixed mortgage instead of a 30, so you're hurrying up to get more dollars in there by having a big payment every month. Appreciation, taking your tax return, sticking it against your mortgage, bi-weekly payments through a bank, so you're paying, every 2 weeks instead of once a month, so you get an extra payment in there every year. All of those strategies are ways to get your dollars where you cannot put them into investments where they compound, and to get them stuck inside of a home as home equity. Well, we talked about this for the last 3 podcasts. Home equity, the dollars you put inside of a piece of real estate, fails all of the tests we use to test a wise investment. Low liquidity, low safety, low rate of return or no rate of return, depending on how you look at it, and bad tax treatment, which we're going to cover today. It does not help you on your taxes, forces you to pay more taxes. Home equity is a terrible place to put money. Now, there's a better place to put money. I want you to be debt-free. I want you to be storing your home equity somewhere and accelerating that by paying as much as you can, putting your tax return in there, paying an extra payment of a year, whatever you can do, extra $100 a month, whatever. Put a bunch of money over there, just don't leave it inside the house. So what are the tax advantages of home equity, or how is the tax treatment handled? Episode 78 coming at you now. Ding, 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 ding. So this is the last and final test, and we're going to ask, we've been using this house that has $500,000 for its value. We've paid it down to $250,000, so there's $250,000. There's half of the value in home equity. Does having $250,000 or any amount of equity stored inside your home have any tax advantages at all? Nope. Nada, none. It actually causes you to pay more taxes because you do not have one of the most valuable tools available to American investors, which is the mortgage interest deduction. There are books and conferences for real estate agents dedicated to helping renters buy their first home, and those conferences and books are solely based on the fact that now their monthly payment is tax deductible because it's a mortgage, and you can deduct all the interest. But when you're renting, you can't deduct that payment. This is one of the most attractive financial tools we have in the country, and people are trying to get rid of it. Makes no sense. Let's do a quick review of tax deductions. Tax deductions allow you to lower your income before your taxes are calculated. If you made $100,000 last year, and you paid $25,000 in deductible mortgage interest. So your mortgage was, somewhere around $2,100 a month or $2,000 a month or whatever. Your taxable income is actually lowered from the $100,000 you made to only $75,000 before your taxes are calculated. Do you see the value in that? You're taxed on less of your income when you have deductions. You saved the taxes on $25,000 of your income because you had a mortgage payment. Yes, you had to pay that $25,000 from somewhere. That's true, which will be covered in later podcasts. But for now, just ask yourself, if my monthly costs were exactly the same to have a $500,000 mortgage and to have no mortgage at all, I know you don't understand how that's possible, but if your costs were exactly the same, which one would be better on tax day, or which one would be better for taxes? All else being the same, income and expenses, not having a mortgage interest deduction increases the tax that you pay in April. In my 11 years of using this strategy, I've seen the following examples which created an unnecessarily high tax bill for the homeowner. 1, using investments or equity from the sale of a home to pay cash for a home. Worst move possible. You permanently hurt one of the tax laws called acquisition indebtedness, you permanently destroy the tax deductibility of the property when you do this. This not only eliminates the mortgage deduction that you could have had on a $400,000 or $500,000 mortgage, but permanently lowers the amount of mortgage interest the owner can ever claim, even if they refinance later in life. Now, what's the second mistake I've seen people make? Using extra monthly payments or a 10 to 15-year loan instead of a 30-year to speed up how quickly the mortgage interest deduction goes away. So you actually use a shorter amortization period, which creates this super high payment. So this big chunk of your cash flow, you're just jamming it inside of your real estate. Remember, every single dollar you choose not to put into investments costs you the amount you would have earned on those investments. An advisor who's worth his salt is not going to tell you only about the stock market. They're also going to know about annuities and cash value life insurance. Cash value life insurance is where most people build their equity savings accounts. It's where we put what you would normally pay against your mortgage, where we store it up outside of the home so it can grow instead of sticking it inside of the house where it's at risk. Well, those accounts have a 30-year average of 8.2% tax-free with no losses ever. Ever. Do you understand me? 8.2% tax-free, compounding for 30 years, comes with a death benefit, comes with long-term care, no losses. After all expenses, you're netting 6 or 7%. So every dollar you stick inside of your house as home equity, whether it's through an amortized loan, extra payments, down payment, whatever it is, every single dollar you stick inside of your house, you're saying, I don't need you to go earn me 6 to 7% tax-free, which is like making 9 to 10% in the stock market. I don't need extra death benefit. I don't need long-term care. I'm just going to stick it inside the house here where it's not liquid. Depreciation can take it away. If my house is destroyed, I might lose it. It's not making any money. I just stick it inside of there because somebody told me mortgages are bad. No, it's a bad, outdated strategy that I have no idea why it's so traditional, how it got so popular. The math says it sucks. You cannot deduct the loss on your taxes when you give up the right to earn interest. So every dollar you stick inside of your house where you're not earning 6 or 7%, you can't deduct that. But if you borrow the bank's money and pay them 4%, you can deduct that, so it only costs you 2.8 to 3%. People, leave your money making 6 or 7% tax-free in the right place. Go listen to the Rich Man's Roth IRA episode and pay the bank 2.8 to 3%. If you're paying them 3 and you're making 6, that's a 100% rate of return on your payment. So it costs you $25,000 a year to have a mortgage, and you're making $50,000 on the same money somewhere else. That's a 100% rate of return. That is why banks and insurance companies think it's stupid to get out of debt. They want more debt because they pay us low interest, they earn high interest. Just do what the bank does and just don't even listen to what they tell you to do. What is the next example? The next one is the third one. Third example of what I've seen in my years where people make a mistake. Retirees with money in IRAs and Social Security income coming in, paying extremely high taxes due to not having the mortgage interest deduction. They tried to get rid of their mortgage payment thinking it would be wise, and it triggers them to pay unnecessary taxes on their Social Security. Sometimes just selling the home you live in and buying a nicer home or buying an equivalent home across the street with a mortgage eliminates most, if not all, of the taxes being paid. As I'm recording this, I'm finishing the editing on my book, Better House, Lower Taxes. It is about how most retirees who own a home free and clear, have money in IRAs, and have Social Security income, all they have to do is sell their house, buy another one with a mortgage, and 50 to 100% of their taxes would be eliminated. It's incredible. If you don't have enough tax deductions, taking money out of IRAs and other retirement plans like 401ks and 403bs will actually allow the IRS to tax up to 85% of your Social Security income. Go to Google, type in the tax torpedo. Weird name, just type in the tax torpedo. Or look at what a friend of mine, Doug Warren, who lives about 45 minutes up the road from me, look at Doug Warren's video on YouTube about the tax torpedo. You will pay exorbitant taxes if you pay off your mortgage, and it's so easy to fix. The fourth example of how people really mess this up would be real estate investors. Someone with one rental property on the side, that's fine, or someone with 15 or more properties. They're trying to pay off their properties so they will, quote, cash flow. Paying off rental properties just takes your money out of circulation where it can't be in investments compounding at 6 or 7% tax-free, takes it out of circulation, out of investments, and forces the rental income to be taxed. You want to have mortgages when you have a rental property so you don't have to pay taxes on the rent. People, one income, no expenses is not as good as two incomes, one expense. I'm going to say it again because it's weird, okay? One income, no expenses. This is what most people think they want from rental properties is rent coming in and no mortgage. That's one income, no expenses. That is not as good. That is inferior to two incomes coming in, one expense going out. What do I mean by that? Instead of paying cash for a house, a rental property, leave your $500,000 compounding at 6 or 7% inside of a life insurance policy. If you don't know how, I'll show you how. That's fine. It's easy. Forget everything you see on Google. That's all crap. They don't know what they're doing. Leave your money making 6 or 7%. Use the banks to buy the house with a mortgage. Rent it out. You've got the rent coming in. You're paying your mortgage payment, and that offsets the income. Ask your CPA so you don't have to pay taxes. What's the other income, though? The other income is the $500,000 you never had to stick inside the house that's making you 6 to 7%. You're earning rent and interest on the same money, and you're paying one expense. Two incomes, one expense will always beat one income, no expense. Look into it, people. Look into it. Now, let's sum up kind of the traditional method or what people do. They try to pay off their mortgage, but in the last 4 podcasts I showed you, every dollar you stick inside of a house, it fails the liquidity test. It's not very liquid. It fails the safety test. You can lose it. It fails the rate of return. It's making 0, or at the best, it's making 2.8 to 3%. And it hurts you on your taxes. It forces you to pay more taxes either on rental income or on Social Security income or just your regular income if you have no deductions. How in the world can this be called a good strategy, people? It's not a good strategy. It's very, very, very traditional, and it's very comfortable because you've been told it's so good, but it's not a good strategy. For years, people have told me that they're conservatives and they want to pay off their home. They see it as aggressive to not pay off their mortgage, or God forbid, take a new mortgage and take money out of your house. What? The alarms are going off now. They see it as crazy to take money out of a home once the equity's been built up in there. That's what we're supposed to try to do, right? People, conservatives, by definition, are willing to make less interest for having less risk. Home equity earns no interest or a very small amount of interest and has more risk than what I'm going to teach you in future podcasts. Can we really call a strategy with no or a low rate of return? And very real risks that I know people that have suffered from all of them. Loss of job, foreclosure, loss of home, depreciation. Can we really call a strategy with crappy rate of return, no liquidity, and a bunch of risks conservative? No. Conservative is being debt-free, the balance sheet method, which I'll teach you in a future podcast, but as a sneak peek, instead of owning a home worth $500,000 with no mortgage, where you have $500,000 jammed in there, you can't get it unless the banks are happy with you, depreciation, loss of home takes it away, and it's not earning a rate of return, or at best it's saving you 2.8 to 3% a year, and it's hurting you on your taxes. Instead of doing that, you might as well have a home worth $500,000, owe $400,000 to a bank, and have your $400,000 of equity sitting somewhere safe, where you can't lose it, where it's protected, where it's making more than the mortgage is costing you. But if that ever changes, you snap your fingers, take your assets, pay the bank off, and you're back to the traditional way. People, there's a better place to store home equity. They're called equity savings accounts. That's not the name of a product. It's something I made up. It's what I call them. Usually we use life insurance, but you can't build it the way that people teach you online because they suck at it and they don't do a very good job. It's got to be built specifically. Go listen to my episode 6 ways to improve your cash value life insurance, and also the Rich Man's Roth IRA if you want a sneak peek of where I've been putting home equity for 11 years. And my clients went through 2008 and 2009, the crash. They went through it like champions. I've got story after story after story of people that protected their home equity before depreciation and are still holding it and compounding it inside of the life insurance policies, because when their home went down in value, we already had it out. It's called depreciation insurance. Anyway, other than that, I don't have any strong opinions on the subject. People, I think you're the best. Keep listening. Keep listening. You're getting smarter. You're getting richer. Keep listening.
Renovating Retirement with Charlie Jewett.
But that's all, folks.